Hi. So what we're going to do today is look at learning outcome 2. Last week we had covered, learning outcome 1, which was basically looking at, the basics of laws which govern, the Companies and Companies Act 2006. So we basically dwelled into a couple of things which included areas around what is a contract, what do we mean by contractual agreement, how do you differentiate between the agreement and a contract. And then we also looked at, the two specific remits of, law, which actually conform to when we talk about companies in general. So we looked at the law of, which is first part was the contract law, and the second was the law of tort. And then we also looked at the law of tort essentially allows us to get some remedies in place. And this would basically mean that at some stage, if there are issues or, if there are problems which arise and they need to be looked at, resolution from a point of view of Companies Act, then in those cases we would resort to looking at, the law of tort, which is basically a wide-ranging, let's say a combination of wide-ranging laws and legislations and obligations and remedies, which allows us to take one of the parties to the court in order to look at, either maybe receiving, say, for example, or collecting debt, or, making sure that the receivables are delivered when a contract is found. And this also allows us to look at some of the remedies which are available, which in case sometimes means that if you're trading, if your company is trading, then in some cases what we look at is sometimes you suffer losses because of exigency factors or wrongful or meaningful wrongdoings. Then in those cases, we look at falling back onto what is called the law of tort and its remedies to be able to correct those wrongful acts or acts of negligence which are done by others. And this allows, in some cases, money to be recovered, goods and services to be recovered, or say, for example, the other party, which is refusing to fulfill the contract or the agreement, is then forced to look at delivering on that contract and agreement to come through. Now, we also briefly looked at how do we ascertain validity of contracts. And when we look at validity of contracts, sometimes we get to hear terms like power of attorney, you have an agent, agency, and how do sometimes, principals in general or companies in general actually appoint agents, and agents which basically, deliver or conduct business on their behalf, which I say the owner's behalf. Then in those cases, we understood basically the relationship between the agent, the owner, and the agency, which is the route through which, the agents appointed representatives or agents basically coordinate and, say, for example, deliver on certain responsibilities because they are authorized to do that on their behalf. Now, that was in first learning outcome. So that helped us set a bit of a foundation to understand why law is important, and how can we use the different branches of law when we deal with companies, formation, or look at legal types of ownerships when we deal with businesses, whether it's sole traders, partnership companies, limited liability companies, or PLCs, charities. So which part of those, when we look at disputes and resolutions need to be arrived at, then what part of law in the English legal system helps us to understand that? And that was all about learning outcome 1. So contract law, law of tort, remedies, and then the relationship between the owner, the appointed agent or representative, and the relationship which is through the agency. Now, in the second learning outcome, we're going to be focusing on understanding, a bit more detail into what is called the Companies Act. And then we will also look at, the insolvency law. So there are certain key legislations which have been passed over the years through the Parliament, and they've become acts. So we look at some of these acts and how they're related to the day-to-day operations and functionings of the company. And in some cases, if the operations of the company or the company stops performing, goes into administration, the company has to, say, for example, look at liquidation of its assets. Then in those cases, what we look at is we fall back onto the remit of what is called the Insolvency Act or insolvency law, and that is what we'll also look at in learning outcome 2. There are 3 main assessment criteria. So we're going to be looking at something that we deal with on a day-to-day basis, which is to look at understanding how companies are formed, what are the main and let's say the minimum documentation which is required to form a company, where do we form the company, basic bits that we normally end up doing, sometimes within this field when we look at financial accounting, management accounting, formation of companies. We'll also look at what could be the roles and responsibilities of, the main people which are required to run a company. So they could be directors, it could be secretary, it could be officers, shareholders. So we'll talk about some part of how the roles and responsibilities of some of the major people or key people involved in the companies, are, and what their roles and responsibilities are. And then we look at the insolvency process. Why does a business or why does a company or an organization go into and claim insolvency? So which is called the Chapter 10 in the US. So when we look at here, companies becoming defunct or not able to pay their liabilities or pay their debts, keep up with their repayments on loans and things like that, the investor or the equity shareholder might come and take the company to the court, and then in those cases we look at the process of insolvency, administration, and liquidation of assets, which would allow the shareholders, preferential shareholders, to be able to realize the money or the money they are owed by the company by the proceed or the sale of proceeds of the assets of the company. So we'll look at this bit in a bit more detail today in the coverage of Learning Outcome 2. So if I switch you back to the presentation, so what we are looking at essentially here is a bit of indicative content which is around, that we're going to cover today, which is around basics of understanding how the companies are formed, what could be the routes of financing, what are the major key players when a company is formed. We look at some background in general in terms of how the Companies Act 2006 came about. And we'll also look at some of the other major legislations which have been passed over the years, as I mentioned, through the Parliament and have become Act, which we sometimes need to refer to or resort to when we deal with companies going into insolvency. We look at the roles and responsibilities of the key, let's say, people within the company, which could be directors, it could be secretaries, officers, which are appointed on behalf of the company to run the company day-to-day operations, management, administration, and of course, shareholders. So we look at different types of shareholders and what kind of shareholding they can have, and what with that kind of shareholding, what kind of roles and responsibilities they can actually do in the organization. And then towards the end, the major part of the discussion is to look at understanding insolvency, which is primarily looking into why companies cease to exist, and when companies cease to exist, what is the process through which the company has to go through. And in general, that is what we will look at when we understand, the process of insolvency. So sometimes when we look at companies becoming insolvent, which would mean that they do not have enough asset or enough money within the company to be able to prove or run the day-to-day operations of the organization in general, and that is where the company would then go into some sort of administration, or would need to look at winding up operations in terms of to be able to pay the money that they owe to lenders, say for example investors, shareholders, and things like that. So we'll start off the Learning Outcome 2 with some general discussion on looking at understanding the key bit of terminology which will come across when we discuss Learning Outcome 2. So basically what we want to be able to do is start off with looking at basic bits in terms of what is a company. So just as we look at discussing things about shareholders and their shareholders, stakeholders essentially, and stakeholders can be of different types. They could be employees, staff, partners, suppliers, government, it could be banks, it could be shareholders. Similarly, what we talk about is when we look at a company in terms of its definition, a company on its own is also considered a legal entity, and it has its own existence. So it is an entity in its own existence. It has its own rights and responsibilities. And sometimes when organizations start over as small businesses, when we look at legal ownership, they start off with maybe say sole trader or partnerships. But at some stage when the company's operations become quite large, and when I look at this scale, when we talk about the classification of companies in the UK in particular, so we look at micro businesses, we look at small businesses, we look at small, medium enterprises, we look at large businesses or large corporations. That is where we try and create a differentiation that at some stage, when a business passes a threshold of certain level, it moves from micro business to a small business. So if your turnover goes beyond £356,000, then you go into something called a small business. And if you're up to, say, 3.5 million in terms of turnover, then you migrate from small business to becoming a small medium business or a small medium enterprise. And in those cases, the turnover then goes up to 12.5 million, and anything more than 12.5 million would be considered what is called a large corporation or a large organization. And this differentiation then follows through in terms of number of employees. So 0 to 10 employees in micro business, 10 to 250 in small medium business, and then anything larger than 250 employees would mean you would be a large corporation or a large company, or a PLC, as we say. And sometimes when you look at companies listing on stock exchange, then obviously we'll say public limited company instead of being a private company. And there are this differentiation and follows through when we look at defining in terms of the limits for the assets that you hold, the profits that you make, and when your accounts need to be audited, or there are mandatory requirements as per the Companies Act that you need to have your accounts audited. So in some cases, businesses over £3.5 million turning over, say in terms of turnover over £3.5 million would be needing to require audit of accounts to be done. Small medium enterprises 6.5 million to 12.5 million would need to be done, and similarly for PLCs or large companies, wherein this differentiation would come about. But generally, a company is formed when you want to keep the liabilities or the let's say the deliverables separate from the ownership of the company itself. So a director of the company could be the owner of the company as well. But when the company is created as a limited company, why it is created is that it creates a separate entity which keeps it separate from a point of view of its ownership, responsibilities, day-to-day delivery of responsibilities, and this separation allows the creation of an entity which is the company. So the company can be sued separately, and it has its own let's say existence. And from that point of view, some of the bits and pieces which the companies are required to do have to be then separated from what the directors have to do, what the employees have to do, the shareholders or the investors have to do, and that allows the creation of this separate entity to happen. So that sometimes when we also talk about limited liability companies or the different types of companies, when we talk about, that is where the differentiation helps us understand how this has to be created or why this has to be created. So in general, when we talk about the types of companies, we talk about two different types, public or private. Public reason, shareholding, the companies are listed on a stock exchange. They would have shares which have been issued and could be owned by members of the public. But when we talk about private companies, we normally look at two different types. So you have limited and unlimited. Most of the businesses set up in the UK, about 3.2 odd million businesses, are small, medium businesses, and they are normally set up as private limited companies. Now, some of them are limited by shares, some of them are unlimited. That means in some cases, the guarantee, of the liability which the company carries or the directors of the company carry, in some cases, then that could be restricted to a certain amount. And in those cases, this particular amount or liability or the, let's say if the company is to undergo some sort of, say, insolvency or liquidation or administration, then the limited liability would be there on the directors or the shareholders of the company. And in those cases, the companies are formed as a private limited company, but by guarantee. That means liability of the members are limited to the amount which have been agreed in the articles of association. So in those cases, we'll cover that in a bit more details later, but that is the essential difference between the two. Now, one of the other things that we also want to look at is we want to differentiate and clearly understand how are private companies different from public companies and what are the key areas through which differentiation could happen. So when we look at this particular table that I've got in front of you, what I've tried to do is basically look out and clearly put out some of the differences which allow us to identify whether this is a private limited company or whether this is a public, PLC or a public limited company. So when we talk about, definitions of companies, and we look at how they're registered, all of them are registered at Companies House, in England and Wales, and obviously similar in Scotland and in Northern Ireland. But when we look at their registration, typically the company name in terms of a public limited company will always end with PLC. So when we talk about Tesco PLC, we talk about Sainsbury's PLC, because here the companies are trading on stock exchange, and what will happen is that the name would end with PLC. Now, if we look at companies which are private limited companies, they will end with either Limited Ltd as a short term or an abbreviation, or it will say Limited, which is the full word LIMITED. So if I say UK Versity Online Limited, so we are a private limited company, and that is where the word limited comes across. But if the company is to list its shares on the stock exchange, or shares are then available to the members of public in general, which would be apart from employee staff, but large number of shares available to public in general, then the company would have to switch over from a category, from a private limited company to a PLC. Now, in most cases, when we look at the other key difference which comes across is that in a public limited company, you would see that the minimum capital which has to be kept at the time of formation of the company, which has to be authorized, is currently set at 50,000. So if you are to register a PLC today, one of the key things that will be required would be that the capital required to basically authorize and file an application, which is the IN01 application that we use, would require a minimum of £50,000 to be put into at the time of formation of the company. But in the case of private limited company, we sometimes look at 1 penny, we look at £1, depending on the size and scale of operation. Sometimes we look at £100. So the number of shares and the capital that has to be initially put in, can vary from 1 penny to, say a couple of £100. But in the case of a public limited company or a PLC, you will need to start off with a minimum capital of £50,000, and that is the current limit which has been set. Now, other differences which basically entail would be, if I start looking at visualizing that, okay, a public limited company can raise money through banks, through shareholdings, through, selling shares, offering long-term bonds, debentures, things like that. A private limited company would primarily not be able to do this, but they will have to look at raising money through overdrafts, bank loans. It could come in from fixed capital reserves, or some sort of reserve which has come from, or investment which has come from the directors of the company initially under the DLA, directors loan account, or things like that. And that would be the reasons through which a private limited company would initially start to would say look at sources of finance. Now, the minimum requirement of number of directors in public companies is minimum 2. In the case of private limited companies, 1. And this is an important differentiation, because generally when you look at credit ratings and things like that, directors of the company, in some cases, when we look at PLC, could be directors of the company on the board, and they could be different from the directors of the employees which are actually running the day-to-day operations of the company. In the case of private limited company, it could be the same. The director of the company could also be running the day-to-day operations of the company, might also be sitting on the board, and then depending on scale and size of operation, at least one director is required, or one person has to be nominated as the director of the company at the time of registration. Then we talk about some of the other differences. When we talk about operational settings which are required, we look at, in the case of public, companies, the appointment of secretary is more or less a requirement. In the case of private limited companies, there was a requirement up until, I think, 2006, but in the New Companies Act, this was done away with. You might not, or you may not have a secretary, or have a secretary, but it is not a mandatory requirement. In the case of public companies, we look at, because they are large PLCs, as I mentioned earlier, auditing of accounts is required. But in the case of private limited companies, micro businesses and small businesses turning over up to 3.5 million do not require audit of accounts to be done through the Register of Auditors. Now, in some cases, when companies file for example, taking long-term loans, looking at a large bit of investment which could be done in terms of purchase of premises, and if they have to go to banks or you have to go to lenders to be able to get money, then in some cases, somewhere, some of these, say, functions would require audit of accounts to be done. But it is purely voluntarily. It is not required as per the Companies Act of 2006, CA 206, because of the fact that this is not a mandatory requirement for micro businesses and small medium businesses. But yes, if your turnover is over 3.5 million, then in those cases you would look at, the audit would be required. Now there's a slight bit of differentiation when we look at the updated guidelines which you see on the Department of Business, Innovation and Skills. Obviously, there were only three categories. You had small businesses, you have small, medium enterprises, and large businesses or large corporations, PLCs as we term them. And the differentiation was turnover from 0 to 6.5 million, 6.5 to 12.5 million, and then anything over 12.5 million. But with the change which was brought in, a new category which was introduced was the micro business, wherein the turnover was 0 to 356,000. Then small business 356,000 onwards to 3.5 million, and then 3.5 to 6.5 million, and that is where the audit requirements begin to happen. So when you're turning over more than that money, that is where it starts to happen. And then some of the other requirements like AGM, annual general meetings, have to be done in case of public companies. Resolutions cannot be passed without an AGM, but in some cases in small private limited companies, we can actually pass a resolution, and that is where the secretary role function comes in, wherein the minutes are recorded, and obviously between the director, if there are shareholders, and the secretary, and then written resolutions can be passed because there's no formal requirement to hold annual general meetings. So in general, when we talk about company, and we talk about why companies are required, how they are formed, we look at these two main differences, and this is a bit that we will predominantly go through. Now, one term which I want to introduce at this stage is what is called the wheel of incorporation. Now, when we talk about the wheel of incorporation, this is a term which basically ensures that a company, sometimes the reason of why we formed a company is that it becomes a separate legal entity from its directors and shareholders. So what it does is it basically protects the personal assets of owners and the investors and the directors of the company from lawsuits if they are to arise, for the company. So in this case, the wheel of corporation, which was created, sometime in the 1916, when obviously during the First World War, Daimler Chrysler and Continental Tires and Rubber Limited basically there was a case which was brought between the two of them, and it basically said that there were 5 shareholders, but one of the shareholders was British and had only one share, and the other majority of the shareholders were all Germans, and they had 4 shares, so obviously they had more voting rights than the one which was the 5th shareholder, which was British. So in this case, what happened was when the dispute arose, because the two countries were at war, so what it allowed that to do is the defendant in this claim, which was the British shareholder, was supposed to supply tires, to the company. And because the two countries were at war, obviously this meant that this was not necessarily required to be done, because in those cases, the effective control of the company was with the German shareholders, and that would have meant that, if you're trading with the enemy during the time of war, this was seen as treason. So essentially, when we look at the wheel of incorporation, this allows, or this can be invoked, or this comes into play when we have situations like this, wherein majority of shareholders are in a different location or with a different nationality, and sometimes when dispute arise, what you will generally see in contracts and agreements would be that all disputes and settlements, or all legal cases and settlements, would be in the jurisdiction of this and this court. So normally when we look at forming companies, what we generally do at some stages in the memorandum of article or the articles of association, you generally see this line being incorporated, which would primarily mean that, in the case of dispute, if it arises and it needs to look at falling into the remit of what is nationality and shareholding has to be looked at, then in those cases, what will happen is that the this particular jurisdiction in terms of which law would apply would actually come into play. And that would mean that in some cases, the actions of the organization can be separated from the actions of its shareholders or directors. And this allows the shareholders to be protected from any liability which could arise out of company's action. So this particular case, which is treated as an example and referred to, is the case that when these German shareholders brought in a case or a case of liability against the British shareholder, that was, let's say, that was not taken and executed, is because the liability of the shareholder is different from the shareholding of the company or the company, because it's an entity. And in this case, because the two countries were at war at that point in time, so there was no obligation, on behalf of the German, on behalf of the British shareholder, to be able to deliver on goods and services which are required to be paid or, delivered on behalf of the company. So this particular aspect, when we look at, the corporate veil, or obviously looking at veil of incorporation, is that it ensures sometimes fraud or intended, improper conduct can be avoided by looking at, taking necessary action which could allow the courts to intervene. And that means in those cases, people behind the company, who are real beneficiaries, can actually be, exempted from owning any liability which the company owes because of delivery of services or non-fulfillment of the contract. So sometimes this comes into play when we look at international jurisdiction and courts, applicability when it comes in. And one such thing that you would normally see in such cases in modern times that we see when we talk about patents. So if a company has patents, and if there are patent infringements which happen, generally you would see patent licensing or patent loyalty, which company typically get in terms of royalty that they get by licensing those patents to different companies. They would always specify very clearly the jurisdiction in terms of the courts where this would be applicable. So sometimes when companies are trading in software or software-related services which involve intellectual property rights, and they could be, one such example would be patent, you would see that wheel of incorporation would become important. Where is the contract, incorporated? What is the court or the jurisdiction which applies? And if there is a breach of contract which tends to happen, then it only can be tried within those, within the geography or within that court, which is actually defined on the wheel of incorporation within the contracts when we look at either the incorporation of the company itself, or when we look at some offshore companies which are formed and they then give the rights or the ownership of the intellectual property rights to be dwelled through different offshore companies. But the jurisdiction in terms of court of law typically tends to apply, which is defined very clearly at the time of incorporation of that company, or in the memorandum of articles or association. So is that bit clear?
Yeah.
Okay. Any questions so far? So we are looking at just the general aspect of why company is formed, what are the differences between private and public limited companies, and this is where we look at just to set some foundation to understand why companies need to be formed. Now, some of the other bits that we also want to quickly look at would be, what are the consequences of formation of a company? Why do we need a separate entity? So one of the things which I've highlighted is that sometimes when we talk about this separate entity, the reason of having this separate entity is you want the liabilities of the company to be different from any such liability which the shareholders, directors of the company would have. So if in case the company fails and the company is taken to court, or there are proceedings which basically mean the company would get into some sort of administration, then in those cases, the assets of the shareholders, the directors, would be different, and they would not have any liability until they've agreed on to that liability in the limited by guarantee part of it, which is specified in the memorandum of articles. Now, when we talk about one of the rules which is important, and this is just from a theoretical perspective, that when we look at companies, that when companies say suffer injury, sometimes what happens is that we look at, the court case or something being brought across, towards the company, and you would see that here, what has happened in this case is that the directors of the company which are running the operations on a day-to-day basis have mismanaged funds. And if the shareholders feel that this mismanagement has happened, then the shareholders can bring across a case against the company. But how do we differentiate whether the case is to be brought across against the company or the case has to be brought across against the directors of the company which are actually running or involved in the day-to-day operation? So this is one such particular case, which is the case Foss versus Harbottle, which was brought across in the early 19th century, in 1842 to be very specific. And here the two shareholders of the company had actually taken action against the director of the company, saying that the directors have mismanaged the assets of the company, which has led to the large-scale creation of loss. And they took the director of the company to court. So in the proceedings which followed and the final judgment which came out, which is now known as the Foss versus Harbottle case, this created a bit of a differentiation or a clear, distinct differentiation between if the directors of the company are involved in running the day-to-day operation and the decisions that they take lead to a loss or some sort of, misappropriation, but the intention is not to look at creating fraud or doing fraud, then in those cases, this would mean that the court was interfering with the day-to-day operations of what the company is doing and how the directors of the company are actually running the operations. So this case is of significant importance because it created a general principle for companies law that an individual shareholder, which was, in this case, when it was brought across, cannot bring a case against a company or complain against a wrongdoing of or through, saying that there are irregularities which are happening because the directors are running the company in that way, which essentially meant that the shareholder was interfering with the running of the operations of the company, and the court actually upheld this particular ruling and said that the directors are fully responsible for making such decisions, and if these decisions do not turn out to be the way they are expected in the long run, then this is a decision or a matter between the company and its directors, not the shareholders of the company. So the shareholders cannot bring a case against the directors in terms of how they are actually running the day-to-day operations of the company. And this is where the court actually came across and made the ruling that, okay, this would mean that the court is actually interfering into the operations. And that is why this particular case, Foss versus Harbottle, is quite important, because it set a precedence wherein it meant that, court cannot intervene in terms of how the company's directors actually run the day-to-day operations of the company. Yes, if the company is unable to pay its debt, meet its requirements, or meet the requirements of its lenders, over a point in time, the lenders can bring across a case against the company or orders against the company to wind it up, to basically recover costs, which would lead to administration or insolvency or liquidation of assets. That can be done, but it cannot be done against the shareholders or the directors of the company. So sometimes when we look at this as a case, which became like a significant, important piece of, legislation, or let's say reference, that is one of the reasons why we look at forming a company, because it becomes a legal entity and it differentiates the way day-to-day operations, decision-making, responsibilities are done within the company's operations from the shareholders and directors of the company. So this is one of the reasons why we look at, the consequences of incorporation. That means why companies are formed, and in some cases, how it protects the people, which is, when I say people, I mean by directors, shareholders of the company, which basically are running it from a point of view of a day-to-day responsibility. Now, we also want to briefly understand what is companies law and why is it important, and what are the various acts which have been incorporated in companies law. So when we talk about the Companies Act of 2006, basically this is what governs the formation of company, running of the company, day-to-day operations, and it is like a bit of a code book which is made up of 1,300 sections and 16 schedules, and this is something that we need to fall back on when we look at referring to what is called the Companies Act of 2006. So there are lots of remedies which are also available along with the sections. There are statutes and there are different sections which are clearly contained in terms of providing us guidance that what is to be done if this happens, or what is to be invoked or when this happens. And these are all a part and parcel of what is called the company's law. So in a sense, if I have to ask you this question, what is company's law? Company's law is the Companies Act of 2006, which is made up of 1,300 sections, 16 schedules, and some remedies which are available, so that in some cases when we are not looking at running the day-to-day operations or executing our responsibilities correctly, we can fall back onto remedies, and these remedies are defined in the Companies Act of 2006. And if remedies fail and we cannot resolve some of these differences through looking into these remedies, then obviously at some stage you would see that court proceedings would follow, and in those cases, we would see disputes and settlements being settled by the court. Now, there was a bit of a revision which has happened, and that's why the Companies Act of 2006, which came about, also has some insolvency regulation included in it. So when I talk about Companies Law or Companies Act of 2006, and I see what are the major components of this, there are two major components. One is related to what is called the security regulation, and the second part of it is called, related to what is called the insolvency law. So when you look at these two things, you would generally see that they have also become specialized branches in which, because obviously this particular law or act is quite huge. So over the years, what has happened is that these have become two specialist areas. So when we look at companies going into and filing for, say, shares or listing on stock exchange, there are lots of security regulations which actually start to come into being. And then when we talk about, in insolvency law or companies going into administration, we understand that this needs to be looked into or, looked at from a point of view of going into what is called the law of, under the Companies Act, we look at what is called insolvency law. And then the third bit that we see now in the early 20th century or 21st century that we have also got incorporated with the Companies Law, although it is not clearly defined or it is not, let's say, this is more of a requirement which is cropped up, and it is not something which is defined in law in terms of that needs to be followed or it needs to be looked at. Yes, there are lots of different things which are now being proposed, and some part of these are being proposed through changes which are coming in through the Financial Services Authority, which was the erstwhile FCA, Financial Conduct Authority, and that is where we see corporate governance being included under the remit of company law. So here, when we look at long-term implications of things like fraud, misappropriation of funds, over-reporting of profits, we look at the ethics side of things, corporate social responsibility, CSR side of things, all those things which are now coming into modern management companies is now being incorporated under what is called corporate governance. So they are, in a way, if you have to understand companies law, there are three sections to it that we get to see. And these three sections that we get to see tend to be related to securities and regulation, where the company is listed on stock exchange. Then you look at corporate governance, and then you look at insolvency law, which is primarily related to companies going into administration or into liquidation. Now, these three, if we have to look at, we look at what are the various acts or various laws which have now been passed through Parliament, and sometimes when we have to fall back into understanding some of these are the key critical bits of legislation that we need to understand. So these are various laws which will be applicable when we look at, say, for example, law or legislation being applied to when we deal with the formation of company, any form of company, and these are the ones which will apply. So you have the Companies Act of 2006, you have the Insolvency Act of 1986, you have the Companies Director and Disqualification Act. So sometimes you would get to hear that the companies have found, or the proceedings have found that directors have done this or directors have done that, and in some cases you would see if proceedings go into the court of law, you would see that some of the, and if they go against the directors, you would generally see that directors or people who are in the directorship of holding the directorship of that company would then get debarred from becoming directors of companies or newly formed companies for a certain amount of time, generally 2 years, 3 years, and it could be in severe cases up to 15 years. So that is covered under if the company is found to have conducted gross misconduct, and that is solely on the director's behalf, then in those cases, Companies Director Disqualification Act to the directors of companies in the near future. The FSMA, as we call it, the Financial Services and Market Act, also deals primarily with, and has close workings with the company law. You have the Criminal Justice Act of 1993, which is also classified as what is called the insider dealing. Sometimes when we look at public limited companies and we see these cases being brought across from time to time, large merchant bankers or, investment bankers who handle funds, and if they have insider information about how the company is performing and how that would affect the company's share price, then in those cases, they use it for their personal gains or personal gains of certain directors or shareholders within the company. Then in those cases, if it is found and they have to be convicted, then they are tried under the Criminal Justice Act of 1993, and that is covered primarily for insider trading or dealing. You have the Companies Act of 1985. Obviously, this was updated, and now it is called the Companies Act of 2006. We also have certain other acts and regulations. At this stage, we just want to understand that this is the remit of the legislation which actually helps us in dealing with court matters should an appropriation say, for example, fraud or any sort of transaction that comes to light that has to be reported to the company's house. And in those cases, some of these proceedings then that follow will go through some of these acts, which are, all part and parcel of dealing with company as a separate entity and are covered under what are called the various sources of company law. Is that okay? Is that clear so far?
Yes.
Yes.
Right.
Yes.
Okay. Let's go into now some of the assessment criteria. The first assessment criteria that we look at, in the unit specification talks about. So after this understanding, let's look at getting into the ACs. And the first one talks about what are the various requirements of how the company is formed. So when we look at the requirements of how the company is formed, we look at various forms. When we talk about two different types in general, we talk about the limited company or through a limited liability company, LSC, and then we talk about the private limited company. So when we talk about the formation of company, we need to understand here is that what are the basic minimum requirements in terms of how the company is essentially formed. So when we look at forming a company, just going back to what I've shared in key terminology, some bits why the company is formed is we want to keep the liabilities of the company different from the liabilities of the owners or directors. We want to formalize some sort of a official documentation process around in terms of the company being formed as a separate entity. And in some cases, the separate entity then has its own set of legal and administrative legislation which applies so that, if the company does not perform or meet the requirements as what has been set, then the people running the company cannot be found liable. And in these cases, different laws typically then come into play. And that is where the Companies Law Act of 2006 allows the differentiation of those two boundaries, to be distinctly understood. And that is where the, reasons, let's put it this way, these are the reasons why we would look at forming a company. Now, how a company is formed, I think most of us are quite aware of it, but just briefly looking at it, if you decide to form a company, I think if I go back 10 years or before 2006, if I go back before 2005, if I go back, the formation of a company required you filling up a 35-page IN01 form. So I don't know how many of you remember the IN01 form, and in those cases, the incorporation of the company required, what is called a fees of £40, which had to be paid for the company to be essentially, let's say, formed. So one of the key things that we look at, I don't know how many of you remember, but this used to be a manual process wherein you had to fill an application form. People sometimes still do it today. And if you fill that form in through the paper, you normally put in an application fees of £40. It's a longish 35-page form that you have to fill in, and that allows you to capture and provide all the details in terms of why a company is being formed, what type of company is it being formed. So in this case, is it a private limited company by shares? Is it a limited company by guarantee? Or you're forming a public company? So all those things have to be specified. And we go through this process of actually forming a company nowadays on the Companies House website or the .gov website. And it normally is a very easy process as against, a very tedious and a cumbersome process if I go back 15 years or 20 years back. Now, when we form a company, there are 3 or 4 basic things which are required. The first is, obviously, you need to fill up a form which provides the basic information about the name of the company, the directors of the company, shareholders. It'll also talk about registered address. It'll have basic details in terms of when the company is going to be formed, what are the services the company would provide. And if you recall, there are what are called the SIC codes. Any idea what are SIC codes? When we use the classification of economic activity codes, which are called the SIC codes, when a company is being formed, you have to at least define one code or one area of service which the company will actually be into. So, for example, retail services, insurance services, banking services, but these are very broad categories. Within that also, there will be very specific categories. It could be personal insurance, mortgage insurance, indemnity insurance. So one of the SIC codes has to be established minimum, which basically shows what kind of activity the company would be offering or getting into, services the company would be offering when the company comes into existence. And the other 2 important areas which are required to form a company is the Memorandum of Association and Articles of Association. So these 3 documents are required to essentially form a company. Now, when we form a company, obviously on the Companies House website today and on .gov website, we are able to see, you can actually do a quick search, whether the name is unique, whether the name is available, what word would you want to add towards the end? Would it be a limited word, which is the full word itself, or would you use an abbreviation like LTD? And sometimes when you look at different naming of the company or, the name of the company, if it comes up already that this company is registered, but you need to then provide justification that why you want the same name to be put, or, would there be a different trading name and things like that. And these are all covered under what are called the Special Resolution of S78 under the Companies Act of 2006. So sometimes you would see that if there are names that you pick out which are already registered trademarks, or there are similar names available for other companies, then in those cases you'll have to come up with a distinct name. And in some cases, if you want the same name to be put in, then reasoning has to be provided to the Secretary of State, and that would allow you to then file that application. And if it is accepted, then the company name gets accepted. Otherwise, you will be reverted back to choosing a different company name. Now, one of the other things that you look at when you make an application to form a company would be online if you're doing it, or whether you're doing it on paper. You generally see that shareholders and share capital has to be defined. So in the case of public company, minimum shareholding or capital which has to be defined is 50,000, which is required for the formation. But in the case of private limited companies, limited by guarantee or otherwise, you would generally see you could have at least 1 share at 1 penny or £1, whatever it is. Most companies are formed with, shares in pennies and things like that. And they are basically intending to formalize the ownership structure of the business. So if there is 1 director, normally you would look at what kind of share he would have, or if there are 2 directors, you would look at number of shares, and they would be divided by putting in that initial seed capital or share capital as we call it. And this allows the ownership structure of the company to be created. Now, when we look at shares, there are different types of shares. Are you aware that there are different types of shares? for a public and a private limited company? Any idea?
Yeah.
So there are how many types of shares which we look at sometimes when you look at forming a company and you do an application online, normally this question at some stage comes as that how many shares you want to define, what kind of shares you want to define. So what are the different kind of shareholdings which can be defined when we form a public limited company or a private limited company?
I think ordinary share. And
that is correct, yeah.
And there is another category like special.
So there are ordinary shares, then you have non-voting shares, you have preferential shares, and you have redeemable shares. So there is a bit of a differentiation in terms of how these shares are defined and why do you create these categories or choose these category of shares is because you want to basically look at voting rights. You want to look at whether these shares can actually be bought back by the company if initially they've been provided by an equity investor. And at some stage, you want the provision to be able to buy these shares back so that you have the shareholding of the company within the company itself. Sometimes you look at issue of preferential shares, which would allow dividends and bonuses to be given off to the shareholders. So there are different types of shareholdings which can be created when you are forming a company. And generally, when I say generally, 90% of the companies are formed with ordinary shares, which primarily only give you voting rights. And in some cases, some companies would then be formed by preferential shares or redeemable shares. And very, very few companies basically create shareholdings wherein you would give certain people shares, but they will have no voting rights in the company. So they could be like sleeping directors or, they could be like investors which have invested into the company, but they are only going to get bonus or dividends at the end of the year of the company or at the end of few years of operations, but they will not have any significant, voting rights into the company. So different types of shareholdings can be created, but generally in the UK, when we look at companies being registered, 90% of them are done through ordinary shares or preferential shares. Now, the other bit that I mentioned was that you have to define, in terms of forming the company, we have to define the directors of the company. So in public limited company, minimum 2 directors have to be defined. In private limited company, minimum 1. Directors' key responsibility is to run the day-to-day operations of the company. They are appointed on behalf of the owner of the company. They could be, the owner and the director could be the same person. And in some cases, the reason of having a director and the owner being different when the companies are formed is, again, to differentiate between the liabilities the company would carry in. There is no personal liability, or the directors of the company, which are also the owners of the company, do not personally become liable for their own assets and their monies if the company is to go into administration or liquidation. Minimum requirements tend to be any director can be, people can become directors as long as they are over the age of 16. And English law does not necessitate, that the directors have to have British nationality. You could have somebody who's a national of a different country or a British overseas territory, and they could still be directors in the company as far as, the directors are concerned when we talk about England and Wales. And generally, there is no maximum permissible limit put by the Companies House on the number of directors which can be appointed, to a company. As I mentioned, one of the key requirements in public limited companies or PLCs is to have an appointment of a secretary. And the main role of the secretary is to look at minutes of the meeting, maintenance of registers, and look at administrative requirements which are important for documentary process towards the Companies House. So filling in of, changes which are happening within the company, if there is a change of directorship, if there's a change of address, if there is a change of major responsibility, which have been major powers or responsibilities have been taken away or have been provided to directors or members of the company which are running, members of the board which are running the company for a day-to-day operations, then the key bits have to be recorded as minutes, and then they have to be submitted, to the Companies House, and that is what the role of secretary is. This, in the case of private limited companies, is not necessary. The director of the company could also be doing the responsibilities of the secretary. And after 2006, when the Companies Act was formed, it was no longer a mandatory requirement for private limited companies to appoint a secretary. And in this case, one of the directors could also be taking the role or doing the function of, a secretary. So when we look at change of company name, in the case of private limited companies, just as an example, we talk about change of company name. So if you look at a change of company name, a change of company name would require an NM01 form to be filled. So for example, if you decide that the company name is ABC Limited and you want to change the name of the company to XYZ Limited because of whatever reasons, then as a person you would need to, as the company would need to file that form with the company's house. But if it was in the case of a public limited company looking at a change or being acquired by another company and the name being dissolved, they would, in a requirement of the Companies House Act, required to fill in the NM01 form, but also the secretary would need to do the minutes of the meeting. The recordings of the minutes would be needing to be done, and along with that, they will need to be submitting the form to the Companies House to be able to get that regularized. But in the case of private limited company, just the form needs to be filled. You might not pass a resolution or do the minutes of the meeting, but as long as the form and the basic administrative requirements are fulfilled, you are allowed to change the name of the company. And most of these things today pretty much happen, in about 5 minutes. So if you decide to change the name of the company, you go to the Companies House or .gov website, click and download the form, and most of these are electronically filled now. And what you will do is type the name of the company. If the name gets accepted and there's no similar name or similar services company name coming up, then it would get accepted, and all you will need to do is confirm, pay the appropriate fees, I think, and then basically £13, and then basically get the name changed. And you similarly get, within a couple of minutes, the new incorporation certificate reflecting. Once you pay that fees, you straight away are able to download the certificate saying the old name was this and the new name is this, and that gets regularized. So the paper-based process takes a couple of days when you have to send that across to Companies House, but online can be done pretty much quite quickly. The other requirements when we look at, formation of a company, registered office, pretty simple. You need to have an office which is the registered address of the company. There are some documents which are required. The other two bits that we talk about, the Memorandum of Association and the Articles of Association, are important, because without which the company's, formation is incomplete. Now, after the Formation of Companies Act of 2006, most companies which are formed online, or, when we form the company, they use what are called the Model Articles of Association or Model Articles of, Memorandum of Association. Unless specifically you want to look at, making a change and then providing that along with your application to Companies House, which would have maybe changes in terms of, certain deviation from what have been defined as model articles or model, association. You would need to file them separately or manually, and that would then come across with your incorporation certificate. Now, MOA, in short, as we call it, basically consists of responsibilities which the initial subscribers of the shares of the company would have under the Company Act, and how would it work with the company or when they become the members of the company. And the AOA, or as we call it, Articles of Association, is generally a contractual agreement between the company and each of its shareholders, and how they would regulate the company when they use their voting rights. So these are basic 3 documents that are required: the IN01 form, the MOA, and the AOA, which is required to form the company as far as England and Wales is concerned. Now, the model articles are adopted, when you file for the application on Companies House or .gov website. You would generally see that if you are not submitting or uploading your own model articles of AOA or MOA, then it is understood that the model articles which have been comprised and created under the Companies Act of 2006 are by default incorporated into the formation of the company. And when you download your incorporation certificate, you would get these as PDF documents that you would need to download, and they would be standard AOA and MOA, which are particularly provided at the time of formation of the company. So this bit allows us to cover the assessment criteria 2.1, which talks about understanding what are the requirements to form a company, how the company is formed, what are the basic minimum documentation which is required, and that covers this particular assessment criteria 2.1. Any questions on this?
No.
Okay. Now, this process, I don't know how many of you have seen, but on Companies House, if I go and I say form a company, if I just quickly put form company, will take 5 minutes in terms. There are lots of private companies that do this, but if I have to just go on to the .gov website and basically say that I want to register a company, this process would not take more than 10 minutes if you have the 3 basic requirements at hand. The company's register office, which is going to be the name of one director, some basic details about the director, and last but not the least, if you're planning to use the model articles, which are for AO and MOA. And that would basically mean that this would be a very straightforward process of forming the company if you have some of these basic details at hand. So if I just go back and just choose no, and in this case, how would you pay for it? If you pay through PayPal, typically you can straight away go ahead and form this. If not, then you have to look at making an application, downloading the application, and at some stage then going into and making the payment to the bank through Companies House, and that process would help you form the company. Now, going to the second assessment criteria, which talks about analyzing the roles and responsibilities of companies, directors, officers, and shareholders. Now, let's look at these responsibilities quite quickly. Now, when we talk about responsibilities of company director, essentially we talk about what are the direct responsibilities and what could be the indirect responsibilities. Now, the reason we say direct responsibilities these are direct responsibilities because the person of being appointed as a director is being appointed because of the skill, the background, the experience. Maybe they could be the owner of the company itself. And in those cases, they have the powers to be able to make decisions. And that is where the direct responsibilities would come about. Some of the indirect responsibilities could be either delegated to the accountants, or could be delegated to persons dealing with the accounting side of things within the company. If there's a finance director or there's a financial accountant, then in those cases, when you look at registration for VAT, PAYE, pensions, confirmation statement, which is done at the end of the year, the form AR03 that you fill in on Companies House website, you look at filing of the accounts, you look at filing of returns in terms of the corporation tax, and then in some cases, if the directors of the company are drawing dividends and salaries, or are getting bonuses from the company, then in those cases, the PAYE and the other bits related to that also will need to be filed primarily by either the person, if they're competent, or not, then in those cases, it will be the accountant or the person in finance which will be doing that. Directors of the company, if they're drawing salaries or dividends and bonuses, they would be responsible and obviously filing their own self-assessment tax at the end of the year. And in some cases, you would generally see these responsibilities would either fall with the accountant. In most cases, it falls with the accountant. And in some cases, if you've registered for, the digital services with HMRC, and you have your own, self-assessment and other things, if you've created a government ID, then it allows you to also do some of these things online yourself. So that means you can look at your own pensions, your own national insurance contributions. You can also manage your PAY, your own self-assessment in terms of tax and other things which are related to HMRC and HMRC related guidelines. So UK being one of the countries wherein HMRC has moved some of these services to online and digital. So as an individual, I can manage them on my own. If I have a .gov ID, which I've created once, or a gateway ID that I have once, and that allows me to manage pretty much everything on my own without having the need to go to an accountant or somebody use a software, because they can be done pretty much directly. And similar is the case with the company side of things. When you look at VAT today, or when you look at PAYE, or when you look at pensions, they can also be automated. But some part of this, when we talk about the duties in terms of being done and done correctly, have to be covered under the duties of the company director. Now, there are lots of responsibilities which the company director has, and some of these tend to be related to unlawful discrimination. It includes looking at things in terms of reporting financial improprieties, looking at theft, fraud, bribery, and you would generally see that companies would have, all these kind of policies in place, and they would hold the director of the company accountable. So sometimes you see in companies you have a whistleblowing policy, you have an anti-fraud policy, you have an anti-bribery policy, and these are policies which are processes and procedures which define if this is to happen, what kind of action needs to be taken. And if the directors of the companies are found liable, that means if this is detected that the improprieties have taken place, then one of the things under the act that we discussed, which was the Directors Disqualification Act. If you remember this particular act, Companies Director Disqualification Act of 1986, you would generally see that directors of the company can also be barred from becoming directors in new companies for a maximum period of up to 15 years if such serious offenses are committed, and these offenses which have been done or have been proved in the court of law, then in some cases the severity can be as high as up to 15 years. Now we look at duties of shareholders. Shareholders are employees. If you own shares in the company, it could be given through to employees as employee stock option plans, ESOP as we call them. Sometimes you would see shareholders could be owners of the company itself, and the director and the shareholder could be the same. In some cases, you would see shareholders, if it's a public limited company, could be members of the public. And in some cases, you would see shareholders being shareholders wherein they have no voting rights, but they have shares in the company, which means that they would be getting bonuses, incentives, or dividends at the end of the year if the company if the company's operations are profitable, and they would derive some financial benefits from it because they've invested capital into the operations of the company. So shareholders are primarily responsible for, ensuring that the company's operations are held accountable. The people who are running the company's operation are accountable. And in some cases, when you look at shareholders, providing or basically using their responsibilities to look at, holding the directors of the company accountable for their day-to-day operations is normally done through what is called passing of resolutions. And these resolutions for public limited companies are done through the annual general meetings, AGMs, because there generally if a company is looking at changing the name, diversifying into a different product category, or looking at going into a new market for expansion, which requires significant amount of capital investment to be done, or utilization of capital reserves of the company, or saying that there would be no, they'll be looking at further issuing more shares, then in those cases, these resolutions or these actions of the company can only be passed through what are called shareholder resolutions. That means under the annual general meeting, the company would need to announce these changes. There's a voting which tends to happen, and shareholders would vote on that. And if the votes are successful, voting is successful, and the company is able to secure a minimum 50% votes on, and then in those cases, those decisions are implemented. So shareholders would have, the responsibility of making sure that some of the actions of the company are held accountable. They are normally done in the annual general meetings for large companies. And in some cases, when you look at small companies, they would be generally being done through what are called recorded meetings. And these recorded meetings would then look at either, diluting the number of shares, appointing new directors, and those are then authorized, or the shareholders of the company have a role to play in that authorization process. And that can happen through either some sort of resolution, which could be either an ordinary resolution or a special resolution, and depending on the circumstances and obviously the scale and size of the company. So this task is broadly about maybe doing a table which could clearly have 3 columns. One could be roles and 4 columns. On one side, you define the roles and responsibilities. On the first column, we choose company directors. Second column, we choose shareholders. And we basically would look at, maybe doing a small table to just cover general roles and responsibilities which people would have within the company. And these would be the 3 key people that we want to look at. People which are basically directors, people who have the responsibility of running the day-to-day operation, which are officers, or, employees within the organization with the shareholding. And then the third would be shareholders themselves, which are given either preferential shares or ordinary shares at the time of registration of the company. And the idea would be to list down their responsibilities in a table, or maybe with a few bullet points, whichever way, and that would allow us to cover the second assessment criteria. So any questions on this so far?
No.
No.
Right. Okay. So let's look at the third assessment criteria, which talks about, explaining the process of insolvency, which is the important bit that we wanted to cover today. Now, why do you think companies become insolvent? Why do you think companies' operations have to be wound up? Any specific, reasons that you've come across, or any, instances where you've seen in the past? Why do you think companies need to be wound up, or they go into administration? What could be the reasons behind it?
One is companies are unable to pay debt.
That is correct. What, any other reasons?
Yeah, the assets are less than the creditors.
Okay. Any other reasons apart from that? Could you think of any other reasons? Both these are correct. So they could be, if I just throw something into the mix, there could be many reasons why a company is being wound up. One, there could be a legal case which is brought across being brought across against the company because of, say, wrongful misdoing. It could be wound up because the misappropriation of funds has been done. It could be wound because, or it could get into a winding process or winding a process because of the fact that the company is unable to pay its, creditors, or in this case, having too much debt and the company is not generating enough business to be able to keep up with those debt payments. It could also be wound up if the company has taken up long-term loans and these loans have not been repaid, and banks would then normally look at starting proceedings in order to wind the company up, to be able to sell some of the assets of the company to recover them, rather than leaving it to leave the company going or running. In some cases, you would also see if the companies have overdraft or arrangements with large banking institutions for working capital arrangements, and if the company is looking at, one such case in instance that we look at, which is the steel company, which is in the news in the last couple of days, owned by, I don't know the name of the company, Gupta. It's owned by, so this company has operations in 8-9 locations. They have put in an application to the government to ask for 170 million pounds worth of working capital loans, which the government has refused. And if they are not able to find a suitable, say for example, investor or an institution which will provide this capital, then obviously the company operations would start to be wound up because they do not have enough day-to-day cash to be able to run the operations of the company. So in those cases, what you would see is that the company's insolvency process would actually would come into play. That means the company's process the company would be starting to wind up, or the company would be, company's operations will be brought to a close. And in this case, if it has significant number of creditors and it owes a lot of money, then in those cases, what will happen is the administrators would be called, which could be any of the big four firms in large cases, Ernst & Young, PwC, Accenture. And in some smaller businesses, what we normally see, administrators are appointed by the bank, and they would normally start taking, hold of the proceeds of the company, the cash at bank, the assets of the company, and they start looking at finding, processes or ways through which they can liquidate some of these assets, sell them off, and essentially regain that money. Now, this process is covered under what is called the Insolvency Act of 1986, which basically allows, the creditors, debtors to be able to bring, or equity investors into the company to bring in that process. And this act, which was passed in the Parliament in 1986, allows a legal platform for all such matters to be settled so that money can be recovered by sale of assets or proceedings from the company because they are unable to run the operations on a day-to-day basis. And that is where you would see companies being, wound up. Now, main part of this, when we look at, the Insolvency Act is covered under the Companies Act of 2006, but obviously is a separate act. And this, as we looked at initially in one of the slides, was that when we look at company law, we look at securities side of things, we look at the Insolvency Act, and then we look at corporate governance. So this itself is a, large branch of law which sometimes needs to be administered in order to ensure that companies and individuals' assets, or in this case directors' assets, are kept separate when an insolvency is brought against a particular firm. And when we look at insolvency, the term bankruptcy, Chapter 10 in the US, they all mean the same. That means at some stage you're trying to close the operations of the company, the assets of the company are being identified. The administrators would come and drop a list of all the debtors or creditors, and in this case, people having preferential shares would be given priority first and would be paid off first. So employees would, even if they don't have shares, would essentially be, non-preferential shareholders, and there, if the company operations are wound up and the money is still owed in terms of salaries, wages to the employees, they would be also a part of that list, but that precedence would be below the preferential shareholder precedence, because this is where the shares and the creation of shares, when we do initially the time of registration of the company or during the running of the company, is important, because it allows us to decide the priority in which how these debts would be settled, who would get paid, and how much they would get paid, and what preference they would have would depend under this particular share classification. Now, when we look at insolvency, what we mean is, obviously it's quite a detailed area. There are lots of reasons through which you would normally see a company goes into administration, but at some stage they come out of administration as well. And in this case, if they are able to secure a new investor or secure enough working capital loans from an investor, and the investors look at buying that company, they bring them out of the administration. But in most cases, you would generally see there's a restructuring which happens. They normally look at making redundancies, look at doing away with some side of operations of the company, or non-profitable operations of companies or sites are normally closed down. And in this case, the entity still continues to function, but then they kind of relaunch the operations of the company which are making profit, or the sites which are making profit. And you would see that administrators, when they come in and they start the liquidation process, they look at all such probabilities to see if, in this case of the steel plant that I gave an example, there are 8 sites which they operate in the UK, and if you see that some of the sites are profitable, like in Rotherham and down south in towards southeast, 2 of these sites are profitable. So if the company is to go into administration, the administrators are called in. What they would try and do is basically do away with sections of the company wherein the profits are not being made, the sites are contributing to more losses towards the overall company operations. They would look at trying to salvage those side of operations wherein the profits is there, the site has orders, or there is a forecast of orders, or predicted orders which is there, and they would try and salvage the operation in such a way that at least the company keeps going. So lots of combinations and permutations can be worked out when a company goes into administration or insolvency, and in some cases the role of administrators is primarily to ensure that if the viability of operations of the company can be maintained, then their main aim is always to look at doing away with the non-profit making sections of the company, and then make sure that the company can continue as an entity in some shape or form if there are orders, or say for example significant revenue projections in place which allows the company to come back to its original or retain its operations and come back to its original way of working. And in those cases you would generally see the process of insolvency and administration being managed in the case of large companies, when we look at PLCs in particular. In the case of small companies, sometimes it's a case of winding them up. Sometimes it could be that the company is not making enough profit, the business has become marginalized, the products and services have become obsolete, and in general the owners would want to close down the company operations, not because it has gone into losses, but generally because sometimes people tend to retire. They have small companies, they have their own businesses, and they would want to retire and basically close down the operations of the company. So that would mean not insolvency, but that is a general case of closing down the company operations without having any, say judgments or county court judgments, or any outstanding debts in those cases. Now, when we look at insolvency, it could also happen because of security regulation. Now here, when we talk about security regulations, what I mean by that is that in some cases you would see there are certain products or services which the company deals into, and in those cases those products say for example create a significant risk, and when we look at shares, bonds, we look at debentures, or look at long-term bonds which the company issues, they do not have the maturity or the yield which they will provide to the investors. So in those cases, the security regulations actually steps in, and what they tend to do is basically ask the company to get delisted, or you see delisting of the company happening from the stock exchange because those assets or the bonds or the shares which have been issued become toxic, or the money from them becomes irrecoverable. And in those cases, you would see security regulations also require the company to, company operations to be wound up, or the company is going to insolvency and administration. Now, if we relate this to the UK in particular, 99% of the companies are outside the security regulation because they're not listed companies or not trading on the stock exchange. So this would only relate to companies which are listed on the stock exchange, on the FTSE, or for example, or other exchanges abroad, when I say, in different countries, and are trading or very large corporations. And in those cases, you would look at this happening primarily. Now, one of the things that we put into context, just to give an example, would be, when we look at the recent global financial crisis, which is something that some of us have seen in our own, lifetime. So this particular financial crisis, essentially saw the Financial Services Act being realigned. The Financial Services Authority, the FSA that we used to call it earlier, their operations were wound up, and a new Financial Conduct Authority, or an FCA authority, was created. And this now sets the rules and regulations as a regulator for most companies which are looking into being publicly traded, and specifically the regulation side of things when companies are essentially trading on the stock market. So most of the regulation, laws, and legislation governing companies which are trading on the stock exchange and are having shares owned by the members of public, their governance in terms of running these companies, and when we look at issue of shares or bonds primarily to the members of public, is governed through the FCA. And with this, we look at also 2 or 3 different acts which are applicable for these large public listed companies. One is the FSMA, which is the Financial Services and Market Act of 2000, and the other one that we look at is the Financial Services Act of 2012. So these two actually govern and help the companies come under a bit of a remit to be able to run their operations in such a way that they are financially viable. And in this case, the securities regulator has the empowerment to be able to audit these companies and their practices. And if it finds say for example abnormalities or misappropriations, then you would see that these companies can also be fined by the Financial Conduct Authority for not running the operations or running the company's operation in such a way that it builds transparency or protects the shareholders' money when they look at making investments or long-term investment decisions. So that side of when we look at Insolvency Act, we basically look at these 3 main bodies and acts coming into play from a point of view of understanding it for a PLC. The act being the under the banner of Insolvency Act, if we look at, we have the Financial Services Act, the Financial Services and Market Act of 2000, and the authority, which is the Financial Conduct Authority, which basically governs these operations when it comes to security regulations for large companies. When I say large companies, what I mean by that is PLCs. And that is how we look at this governance being done in coordination with the Insolvency Act if such PLCs have to be wound up or they go into administration. Is that okay? So that basically covers the task 2.3. Now there are 2 quick criteria that I want to cover. One is the merit criteria, which talks about advice on insolvency process for a given situation. So here, what we want to be able to look at is a bit of a case study or an example of how you would advise a company if they are to go into an insolvency or invoke this insolvency process. So essentially, the main point that we have to cover in this particular task is to talk about a few important bullet points or few important areas which you as a person would be advising them if a company is to say that the company would need to start the insolvency process, that means the company would need to go into administration. They would look at invoking one of the sections of administration or liquidation, and there could be various sections. Under Schedule B1, you have sections 239, 123, 214. There are lots of different sections. So here, sometimes you would look at when the company is going to insolvency, and we discussed briefly some of the points, like they're unable to pay their debt, they cannot maintain their day-to-day operations because there is not enough cash flow. The company's products and services are becoming defunct. They are heavily being affected by the competition operations, substitution of products, which means the sales are declining, and it's a given that the company will not be able to sustain its operations. And they normally start to look at selling off certain assets to shore up the operations. In some cases, they sell some sites off. Some companies, they stop producing some of the product lines which are making losses or not selling. Inventory losses are written off. But even after all that process being done, still the company's operations are not viable, then they would look at, calling in the administrators. Then in those cases, when you look at that as a process, then what we have to do is give a bit of advice in terms of taking a practical example, and that advice would be looking at maybe taking a scenario or a case study scenario, which would primarily be helping us achieve this task. So if you have dealt or heard or have read about a scenario wherein a company has been, the administrators have been called and the company has become insolvent, then that practical example would need to be quoted here. And what is the piece of advice that you would give would actually be the actual requirement of, accomplishing this task. So here, an example that I've taken as a small bit of case study is that a company has, called in the administrators because they are not able to, have enough cash to be able to run their operations. And in those cases, the administrators would then, what is the piece of advice the administrators would give? And that has to be, taken up in the case study example. So for this particular task on Moodle, you would see a case study that I will put up just after the lecture, and that could be a reference to complete this task. Or if you have any other case study or example that you would want to bring in and use that will also be workable. But the main point of this particular task is primarily to advise on the insolvency process. So taking a practical example, what could be the steps that you would advise as administrators? If you wear the hat of an administrator, what are the steps that you would advise the client in order to invoke that insolvency process? That is what has to be covered in this particular task. Now, the last task is, which is the distinction criteria. It talks about analyzing the aspects of capital maintenance. Now, any idea in terms of what is capital maintenance? Any idea? Have we heard about or have we seen this being put across in the balance sheet or, any sort of income statement or expense statement, cash flow statement? What is capital maintenance? Have you come across this term? Anybody? Just any ideas? All right, no problem. If you look at capital maintenance basically is, the amount of assets which the company has. And at some stage, if it's a running business for a number of years, what will happen is assuming if you're a manufacturing business, a business into production or manufacturing, and you invest into equipment, and that equipment has to be replaced every few years, say 5 years, 10 years, 15 years, then at some stage, people within the finance side of things within the company would look at ascertaining that what would be the capital required to buy new machinery, for example, or invest into a new piece of equipment because the current machinery is coming to its end of life or is maybe having more costs in terms of repair and, it's not delivering on the output. So sometimes when you look at the net assets, which are also in the balance sheet of the company as, office site or, for example, machinery and things like that, which actually amount to the net assets of the company. And at some stages, the company is to review that net asset process to see what kind of capital or money it could generate by selling off those assets, by replacing those assets. Would the efficiency or the productivity of the plant would go up? And when you look at such decisions, that is where you would look at the idea of capital maintenance coming in. Now, you look at the current pandemic, just as an example. And what we see is a lot of companies are not utilizing their office spaces. So some companies who are on lease have started to either renegotiate their lease to bring it down in terms of the tenure. In some cases, some of the companies, if they're looking at shoring up profits or, looking at that these sites would not be no longer required because of the fact that the operations have got reduced, redundancies have happened, or they see a permanent change happening in terms of work place requirements, then some companies would look at selling those assets off, and they would then bring those assets into the balance sheet, and that would increase temporarily the profit of the company, because that is coming. When I say those, what I mean by that is the money which is coming in from the proceeds of the sale of an asset and is coming into the balance sheet at some stage would be considered under capital maintenance. Some point of that could be that some companies would look at essentially investing this into other areas which would allow the company to make money, or obviously return say money in terms of their investment. Sometimes you would see companies do not keep too much cash reserves in their account, because they are not able to accrue that much amount of interest from the banks in terms of the money lying in the bank. But in those cases, company would then look at investing that money into other places in order to get more return on the capital being invested. And that side of process, whether it's option one, option two, but the idea is to look at increasing the cash which is available to the company, either by sale of assets or sale of stocks. In some cases, looking at decreasing the payments in terms of dividends, or renegotiating what is called the credit limit which they enjoy from their partner suppliers, would essentially look at all dealing with what is called capital maintenance. Now, this particular concept of capital maintenance, you would generally see is concerned with sometimes the net change in account balances which happen over a period of time during the accounting cycle that you do. And this is primarily required because when you look at depreciation, for example. Now, when you look at depreciation, and when you look at, if the company has to replace, for example, 500 PCs or 50 PCs in an organization, at some point in time, you would also calculate what is the amount of depreciation that you'll be able to claim over a period of 3 years or over the period of 4 years. And that would be, at some stage reflected into your balance sheet under assets and liabilities. So when we talk about the aspect of capital maintenance, we basically see this as, one of the, rules, or let's say one of the tools which actually we apply when we look at the essence of how company would be able to maximize its return on investment, which could be done through investing the money derived from some of the assets of the company which are not being utilized, capital reserves, or by renegotiating aggressive credit terms with its creditors, suppliers, partners, distributors, and that allows it to reappropriate this money to be able to put into other useful activities. So here, the rules of capital, rules of maintenance of capital exist in order to allow the company to be able to return more profits to its shareholders, or bring in more proceeds in terms of profit, increases in working capital in terms of day-to-day operations of the company. And this is something which is important, because sometimes when you look at reflection of or the use of this particular rule in the reflection of statements which are prepared to be submitted to Companies House, you see there are lots of inappropriations which can also occur in terms of such reportings. And an example of this that I'll give you would be the Tesco, let's say, let me use the right word. So this, Tesco misrepresented their profits in 2017, and for which they were fined, and the company financial directors, and when the proceedings was brought across, they were fined because they had basically misreported their profits by, by doing this misappropriation of capital maintenance. And this was primarily, I think, in 2016 or 2017. So we'll just quickly look at Tesco fraud scandal. Yeah, so if you see this, just as an example, if I show this to you, So this is an example of how, Tesco essentially over-reported their profits by using the capital maintenance rule, and this then led to them being fined, by the Financial Conduct Authority, wherein they over-reported their profits by 263 million. So these kind of financial irregularities, which can happen primarily, by the use of what is called capital maintenance rule, is to be explained in this distinction criteria task, which is basically what are the aspects and why it is used and how it can be misused in the case of large companies when they look at shoring up their balance sheet or shoring up their profits, and that is primarily an accounting scandal or it's misrepresentation of accounts, and that is what is required to be covered when we talk about the aspect of capital maintenance rule. Is that okay?
Yeah.
Yeah. So here again, we will need to look at taking a bit of an example in terms of how this is done. And I would suggest that in the recent most memory, I think this is the one that we see, which is the watchdog closes a 5-year probe into Tesco's 250 million accounting scandal. And this could be used as a bit of a reference case study to talk about the capital maintenance rule and cover this particular task. Okay, so I will include a link of this in the slide so that if we need to refer to this, that can be done, and that would allow us to cover this particular task. So any questions on today's session?
No, it's fine.
Mr. Raman?
Yes, go ahead.
Yogesh. Okay.
Yeah, hi.
I have a couple of questions. On the initial assignment, the questions are, I can't see the 2.3, they explain the process of insolvency for business organization.
Mm-hmm.
That is not included on the assessment PDF, and also on the merit question, advice on the insolvency process for a given situation, that also not there on the assignment questions.
Let me just quickly look at the assignment brief.
So task 1, that was.
So let's look at the assignment brief. Though we will do a discussion on this towards the end of the session, but just briefly looking at the assignment brief right now. So here in task 1, normally when you look at the assignment briefs, what will happen is they will start off with tasks in a bit of a different manner wherein it tends to flow. It creates a flow. So here in the task 1, essentially you will see that they've started off with learning outcome 2. And in learning outcome 2, they've given you a bit of a scenario. We can assume this scenario as we go along. And then with that scenario, what they've done is they've basically looked at covering 2.1, 2.2, and then in the distinction criteria, they're talking about the aspect of capital maintenance. If I go into task, then later on, if I go into task 2, what you will see, so in task 1, there are a number of criteria being hit. So in task 1, I have section A, then I have section B. So section A covers 2.1, 2.2, and the distinction criteria which is given here. So these are basically, if I relate one bullet point to one tasks. So this is 2.1, this bullet point is 2.2, and then we have 2D1. Now, if we go into what you're saying is that task 2.3 and 1M1 or 2D1, 2M1 is not covered. So if I go into task 2, as you can see, here they've covered 2M1. Because 2M1 is, they normally would try and relate this to, rather than me ask you a lot of questions saying, I'll talk about question 1, insolvency, then question 3 is also insolvency, and question 5 is also insolvency. What I will do is when I give you a scenario, I will combine the insolvency questions or tasks with a particular scenario which is given, wherein it is most appropriate for you to cover that evidence rather than having to elaborate every time. So some of these criteria get clubbed, according to the scenario given, so that you do not need to again and again go back and refer to those tasks again. So sometimes you would see like 2.3 and 2.2M1, as you were saying, are missing, are covered in task 2 essentially, because it will make more sense to talk about, the process of insolvency, the advice that you would want to give, and how it would happen, because this scenario of day loan limited would actually cover all the bits and would allow you to address it here rather than in the initial start of the assignment.
Okay, that's fine. Because what I'm doing, because I'm doing part by part, that's why I asked the question. Because
see, there are two ways of doing the assignment brief, which is also explained, in the induction side of things. One is some of us actually pick up the unit specification, which is this, and then we try and do the task because we find this easier because we've gone through the presentation and the content. So this is called the unit specification. So here what you'll do is you'll be doing it task by task, question, answer, question, answer, question, answer. But if I see it this way, what will happen is that you'll end up covering quite a number of tasks. If there are 5 here, there are 5 here, 10, then you have about 4, 14, and then you have about 4 here. So about 18 tasks you'll end up doing. But if I do it through the assignment brief, if I show you that, what I will then get is slightly better output, because I will be able to cross-reference and cover some of these tasks off by addressing the scenarios which are given. So here I might not be directly doing 18 tasks, but I'll still be accomplishing and achieving the unit by doing them in task activities or scenarios which are given. So you would see here, they would club some of the scenarios, more or less the tasks would remain the same, but some of the scenarios will allow you to assume a background. And with that background, we don't need to refer to a case study or bring a practical example from outside or look at finding examples to quote, because what they've given you is a bit of a background here to assume. And with that, you keep in mind, and then you start answering those, tasks. So some part of this would be easier to do it through the assignment brief rather than individually going and doing them as a question answer session by following the unit, specification.
okay, thank you. Yeah.
Is that okay?
Yeah,
so,
I got it.
We'll do this discussion later, after the 4 learning outcomes we've covered, and
Sure.
we are going to do a full debrief session on how to compile the evidence for this. So that will be done after the session. And I would always suggest that we do and go by the assignment brief, because it becomes easier to cross-reference and cover some of these off by not writing pages and pages or, using a lot of examples, because they make sense and there's a logical flow to doing these.
Okay.
Okay, no worries.
Okay.
Any other questions for today?
No.
Okay, let me just quickly ask one moment. So Andy, any questions at your end? Tarun, any questions at your end?
No, Ramon, thank you.
Okay, Mr. Hawk, any questions at your end?
No, fine, thanks.
Okay, good stuff. So I'll end the session here today.